Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Pierre Debbas, managing partner of Romer Debbas, to discuss what lies ahead for the commercial real estate space. Pierre, it's great to see you as always. Welcome back to Trade Talks.
Great seeing you, Jill. Thanks for having me.
You got it. Just how much U.S. commercial real estate debt is due for repayment by the end of 2025?
Yeah, at the moment, it's anticipated that we have $1.5 trillion of debt coming up for maturity between now and the end of 2025. And this is for the commercial real estate market where, I always explain to people the reason that we have so much debt that's looming in the next year and a half is really due to the fact that there was a big refinance boom in 2013, 2014, given the fact we've been living in a low interest rate environment since 2009. And the terms of these mortgages are 10-year terms that have built in significant prepayment penalties. So these owners would not have had the opportunity to refinance in the last few years, taking advantage of even lower rates, because the loan documents basically prohibit you from refinancing during that term, where if you do, you have a substantial prepayment penalty where economically it won't make sense for you to take advantage of the reduction of rates. And generally speaking, that prepayment penalty doesn't exist between anywhere from 30 to 90 days before the maturity of the loan. So that's why you have such a looming amount of debt coming up by the end of 2025.
Just how much have commercial real estate values decreased?
That's a tough one because it really depends on the asset class. When you look at office buildings, you look at industrial, you look at multifamily, you look at retail, all different analysis. Office is obviously the one that's struggling the most with the impacts of the pandemic. I was just reading this morning of a office building in San Francisco that was pre-pandemic worth $300 million, and now is vacant, and they're anticipating getting bids for $60 million. It's really a shame what's happened to a lot of the office market in major cities. And, we're over 3 years into this pandemic, when the pandemic first came about. And I always say that the working from home hybrid component has become a fundamental right for most of the labor force. We're seeing major institutional banks require people to come back in. We're seeing companies trying to require people back in, 3 days a week. But at the end of the day, the office sector will never be worth what it was pre-pandemic. I mean, the world has changed. I think we will have a little more normalcy as time goes on. We are also in the midst of a recession, and a recession can be actually beneficial for the labor markets because you're seeing the pendulum shift more to the employer than the employee, which is what we've been going through for the last several years. And that shift will result in more of a requirement to come back into the office, but it won't be 5 days a week. I don't think you're going to see many companies take that approach.
How's the commercial real estate sector financed, and how concerned are you about refinancing?
I'm really concerned because at the end of the day, when you look at multifamily rents have increased significantly with the massive relocation of society over the last 3 years. And at the same token, the housing market is incredibly tight supply. Pricing isn't coming down, albeit the Fed thought that their interest rate hikes would bring down pricing. And a good chunk of what would be home buyers are going to be forced to be renters forever. So even if we have, let's just say the relocation of society is slowed down, and that's going to bring down the sharp increase in rents, they should remain relatively flat in most major areas of the country due to the fact that these people can't unfortunately buy a home. And in keeping rents flat, now the interest debt service is going to go up significantly with where rates are today. Are those loans going to pencil out? And I'm using multifamily, which is the strongest asset class in the commercial market. We're not even talking retail and office. So I think what you're going to see, the reason I do have this concern is that I do think rates went up too fast and too high, to be quite honest with you, where clearly I think our economy is struggling to adjust to this new interest rate environment. And secondly, it's going to force, capital calls for commercial owners. It's going to force workouts with banks. You're going to see an uptick of foreclosures. And it's going to be difficult to just smoothly refinance all those loans like we have seen in the last couple cycles. So I do think, the one good thing is it seems like banks are more amenable to working out with borrowers, understanding the severity of things. But, between now and the end of 2025, we're going to see a lot of different trends we're not accustomed to seeing in our market.
Yeah, it's going to be interesting to see how this plays out from a social perspective as well, because if you're strongly encouraging workers to come back into the office 4 or 5 days a week, you have the cost of commuting that's gone up. You've got the cost of just basic living. What's it, 10, 15 bucks for a salad in the city, right? And then you can't afford to live by your office. So it's there has to be some sort of medium somewhere.
No, I mean, the current inflationary market environment is horrific for what we're going through. I mean, it really starts back from, when COVID first hit. Quite frankly, my personal view is that the Federal Reserve had, reckless economic policies and printing absurd amounts of money. Honestly, Jerome Powell should apologize to the American taxpayers for creating this, because we flooded the economy with fabricated money, right? We printed money with a reckless abandonment, put into the system, and created increased spending power, less need to work. It created issues with supply chains, and now we're trying to reverse it by increasing interest rates at some astronomical pace in a matter of 9 to 12 months. It doesn't, the economy can't absorb this. And you're right. Like, we're seeing this now in that, people can't afford to live, let alone take on additional costs they haven't been incurring for the last couple of years. I mean, everything's absurd now. The cost of commuting. I mean, you're joking about salad. Go get a coffee for $7 across the street. We're talking coffee. It's laughable in many regards. But that is a factor that people are going to say, okay, well, wage growth is slowing down. We're not having the same wage growth that we had the last few years, and cost of everything under the sun has gone up significantly. Why? You tell me why I have to come in 5 days a week. And that's a tough answer. That's a tough question to answer. When you see the institutional banks, Goldman Sachs pays more than anybody else in the country. They can require you to come back 5 days a week. Small businesses and the greater majority of businesses that exist can't compete with that. So in competing for talent, you're gonna have to give in on flexibility, which has become something everybody's become accustomed to.
Yeah. All right, Pierre. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.